Looking to 2020 and Beyond was a live webinar that was originally produced on Thursday, December 19, 2019. For this webinar, we were joined by Mark Heath, Partner and Director of Tax Services, and Charlie Eisenhart, Senior Tax Manager, both with McKonly and Asbury. We hope you enjoy this recap, and please visit us online at macpas.com for more information about our future webinars and other events.
Good afternoon, everybody. This is Charlie Holiday Hustle Eisenhart and Mark Holly Jolly Heath, and we are coming live to you from Studio 1A here in Camp Hill, Pennsylvania. Thank you for taking the time out of your busy day. It's always appreciated. We enjoy you making the time for us. Today, we're going to talk about 2020 and beyond. How are you doing, Mark?
I'm doing great, but apparently not nearly as well as you are.
Nope, I had a 5-hour energy drink this morning, so I'm feeling it. So today we're going to talk about, we're going to do a little holiday theme for you. We're going to do the 12 days of tax reform. And then we're going to talk about the Democratic National Committee candidates' tax proposals and Donald Trump's proposals for going in the future. So let's get this party started. Day one. Consistency. I tell you what's the most underrated thing, Mark, is the idea that, like, with a Democratic Congress and a Republican Senate and President, we're not seeing a lot of change, which is kind of nice for us tax people.
That's very true, particularly coming on the heels of what we had to go through in 2018, what everybody had to go through in 2018, trying to figure out what all the new tax rules were.
Yep. I mean, we're going to start off here to go over where we started. So what the tax reform stuff, and then we're going to spend the next 11 points to talk about, the changes from 2018 to 2019. So, all right, let's start off with the business stuff. Meals and entertainment, 50%. Now it was before it was some individual stuff, depending if you bought for your employees, that was 100%. There were all these different rules. Now it's 50%. So
yeah, they simplified it a little bit for us. So now generally all meals are only 50% deductible. Previously, if it was on the employer's premises or if it was for a specific business type meeting, you could deduct the whole thing. Now they're basically saying all meals are 50%, with the exception of like a holiday party. That the meal portion of that is fully deductible. Don't ask me why, but they did carve that out. But if you're having a meal and entertainment at your holiday party, you have to carve out the entertainment piece and say that is 0% deductible, while the meal would be wholly deductible.
Mark, what if I only get one bill and they don't break it apart? Is it 50%? Is it 100%? Is it 0%? What am I allowed to do if I get no bill and it's just one bill that says, party?
What I would do is go back to the vendor and say, hey, I need you to break out the meal portion of this for me, because every single time, what's the IRS going to do? They're going to come back and they're going to say that is 0% deductible because you don't have the documentation of what was for the meal and what was for the entertainment. So if there's any entertainment portion of it, it's automatically all entertainment.
Excellent. Yes, that makes the most sense. So next one on our list is business interest expense limited, 30% of taxable income.
Yeah, so this is a fun one. This was one of the more ambiguous aspects of tax reform. So basically, and we're going to talk a little bit about planning for this in a couple slides. But basically, if you have a decent amount of interest expense, there's possibility it's going to be limited to 30% of your adjusted taxable income. So we have taxable income, and then we have a whole bunch of other definitions, and now we have a new one called adjusted taxable income. For purposes of our discussion, you basically just say adjusted taxable income is taxable income plus you add back your depreciation expense, you add back your interest expense, your net interest expense, and then you add back depletion, that kind of stuff to get to your adjusted taxable income. Multiply that times 30%. Your interest expense is going to be limited to that number. Like I said, we're going to talk a little bit about that because that's going to be changing in a few years. We're going to talk about that more in a few slides.
Cool. All right. DPAD was repealed. That's something for us tax nerds that we have to deal with. The unintended consequence of tax reform, Mark, there is qualified fringe parking expense.
Yeah, this was one of my pet peeves that you might have heard me talk about this about a year ago. So basically, this was one of the mistakes in the Tax Cut and Jobs Act. One of the unintended consequences is probably a better way to put it. So when they passed the bill, they could only get 51 votes, and they knew that. So they had to do it through budget reconciliation, which means that they can only increase the projected budget deficit by $1.5 trillion over the next 10 years. So they got all the stuff in there they wanted to do. Someone who's way geekier than we are was in a back room calculating the effect on the deficit from all these things, and they came back at like 1 o'clock in the morning and said, hey, we're $100 billion over. You need to find $100 billion worth of revenue. So they said, hey, why don't we say if you're providing parking for your employees, then that should be taxable, or not, either taxable to the employee or non-deductible. And on the surface, it's very simple, because there was a provision put in probably, 15 years ago that said you can pay for a parking spot for your employee in a parking garage. So say you open an office downtown, and now you got to move your employees down there, but now your employees are going to have to pay for parking, $100 a month, and the company just says, you know what, we're going to pay that for you. Previously, that was deductible to the company and was not included in the employee's income. So they said, hey, why don't we just say that's no longer deductible, or it has to be included in the employee's income. And everyone was like, yeah, that's cool, we'll do that. So they did that. Unfortunately, when you trace back through all of the rules, this ended up applying to when they just said parking fringe benefit is now taxable. They went through and said, well, this actually applies to the cost of any parking that's provided for an employee, not just paying the bill for the parking garage. So if you have a parking lot in your business that you're paying to maintain, the cost of that is no longer deductible to the extent that it's for your employees. If it's for clients, it's fine. If it's for your employees, that's non-deductible. And it's a rather convoluted calculation to get there, but the IRS has said they'll accept any reasonable method of calculating this. The second punch of this that makes it even worse is for tax exempt organizations. This is actually going to be unrelated business income that's taxable to the exempt organization. So now, if you have an exempt organization and you have a parking lot that your employees are parking in, chances are you should be paying unrelated business income tax. Now, is the IRS going to come track you down? Are they going to go to every nonprofit around the country and say, you have a parking lot and you have employees parking there and you have no clients, you owe us some money? I don't know. That'd be a tough one to sell, that they would actually do that, but it's something to be aware of.
Yeah, nope, that's unfortunate. But when you do these things at the last minute, that's what happens. The next two are pretty self-explanatory. We had increased Section 179 expensing, which is when you buy something, you can expense it right away. We went from 5, 10 to $1 million, so that's always good. And then, we thought it was going to go away, Mark, but it just never seems to go away. Bonus depreciation is back again. It's now 100% bonus until 2023, and then it's slowly going to phase out, which we'll talk about later. And luxury automobiles, we increase the amount of depreciation you can take on there. So we're allowing you to take more deductions, which is probably why we're limiting our interest expense on the second page. So do we want to talk about qualified improvement property here for a second and the unintended consequences from there with this too?
Yeah, we might as well while we're at it. So previously, leasehold improvements, and that covered retail, restaurant improvements. They had 3 different categories for them. They were all deductible over 15 years, and they were eligible for bonus depreciation. So what they did was, in an attempt to simplify it, they scrapped the 3 different categories of leasehold improvements and just said, we're just going to make one qualified improvement property category. So they did that, and then they changed the bonus depreciation rules to make to phase it out, but they forgot to tell you what life the qualified improvement property was going to be. So it defaulted to 39-year property, which means it is not eligible for bonus depreciation. And they forgot to say that it should be eligible for bonus depreciation. So right now we're stuck with qualified improvement property, leasehold improvements, as being 39-year property and no bonus depreciation.
And the chances of that getting fixed are probably
zero.
Yeah.
They actually, I forget if there was a vote slated for it today or if it got delayed. They did pass a budget reconciliation bill that had a whole bunch of tax features in there, none of which though were the tax corrections that they wanted to make to the Tax Cut and Jobs Act. They extended a whole bunch of stuff from credits and a couple other minor things from a few years ago that were set to expire or had already expired, and but everybody knew they were going to extend them retroactively. So they got all that stuff done, but none of the fixes that were included in the in a tax reconciliation corrections bill, rather, none of which were in there actually got passed. So we're stuck with it for now and forever, for all intents and purposes.
Yep, that's government for you. All right, we're going to move on to more business stuff, but these are more C Corp specific, the big C Corps, not the small Schedule Cs. This is the big one. I think this is really what they wanted to do when they started this on the whole place, was to get the corporate rate reduced from 35% to 21%. So, I mean, that's pretty self-explanatory. AMT is gone. Thank the Lord. AMT has finally been repealed. And then there's that nice little refundable credit piece. And then there's the loss limitation of 80%.
So they reduced the C corporate tax rate, the C corporation tax rate to 21%, which is a big deal, and it made us more competitive on the world stage, which probably needed to happen. You can argue is 21% too low. You can argue whatever where it should be, but that was kind of necessary. The funny part is, we all made this big deal about how they repealed the alternative minimum tax, which they did. But what they really did in the end was basically say, now everyone's subject to the alternative minimum tax. It's just the regular tax. Because before, they said the alternative minimum tax, you had change depreciation, you had to do a couple other things to get to your alternative minimum taxable income, and then you'd be taxed on that if that was higher than your regular corporate tax. So, and a big piece of that was an NOL limitation. You could only offset 90% of your alternative minimum taxable income with net operating loss carryforwards. So they got rid of the alternative minimum tax, but then they just made the ordinary tax. They're limiting your NOL utilizations for NOL carryforwards to 80% of your taxable income. So they kind of ended up at the same spot, but it does make it a little more simple, a little more predictable, which is nice. The key thing though about the loss limitation, so NOL and net operating loss carryforwards in the future, you're only going to be able to offset 80% of your taxable income with it. That applies to losses originating in years ending after December 31, 2017. You'll notice I put some emphasis on the word ending. This was an oversight in the bill. It was supposed to say beginning after 12/31/17. So it would only apply to 2018 net operating loss carryforwards. So what they ended up doing here was passing a law at the end of 2017 that was applying to activity that had already happened. So if you had a net operating loss in your 2017, if you're a fiscal year taxpayer, say your year end was 3/31/18, that net operating loss generated in that year is going to be subject to this limitation, and that was not part of the plan. Now, does anybody really care? Most people don't. However, there are some companies who, maybe they are a March 31 year end, and they said, in year one, we're going to have this big net operating loss that we'll be able to offset in year two. We're a startup. We're going to make money in year two, but in year one, we're not going to make any money, but we won't have to pay tax until at least year three. Well, congratulations, you now have a tax liability in year 2 because your 2017 tax year net operating loss, you can only use 80% of it against taxable income the next year.
Yep. Nope, that's not something we're going to be paying more attention to, especially as we eat through those older layers where we can take 100% and then have to do a little calculation and make sure that we're not thinking that we have 100% when really it's only 80%.
Job security.
Yep. Yes, sir. Now we're going to go on to the go back. We
skipped a column.
We did. Now the part that's supposed to make everything super simple is the partnerships, S corps, and Schedule C is the qualified business income deduction, which is not very simple.
It was supposed to be.
Yeah, it was. 20% deduction on your business income, but you had to meet certain requirements, and then once you get above a certain threshold, then you have to factor in wages and property, but only qualifying property and there's certain lives. But just suffice to say, for the purposes of this course, that it's 25% on business income, 20% on business income, and that it's good for taxpayers. I know a lot of businesses made a lot of money that they saved a lot of money on this, but
yeah, this was a reaction to dropping the C corporation tax rate down to 21%. So while there are plenty of C corps and they pay plenty of tax, the vast majority of taxpayers are flow-through entities. So on the business side, so all of the individuals, because that's where all the flow-through actually, or most of the flow-through income ends up being taxed. They all said, hey, you just gave this giant rate cut to C corporations. What about us? So they just came back and said, okay, fine. We're just going to give you this random 20% deduction off of your business income. But they said it only applies to a trade or business, and trade or business has no specific definition. It is included in the Internal Revenue Code, but it more kind of outlines what a trade or business is not, as opposed to saying what a trade or business is. Then they put a whole bunch of other limitations on it, consulting, which we have gotten more definition around that consulting aspect of it, but there's still definitely some gray area. And rentals, if you just have a triple net lease, you're not active in actually renting the property, it's probably not going to apply to you. But what we've been doing, and what other tax professionals that I've talked to have been doing, is saying, we're going to follow the law, and we're going to look at all of the rules, and we're going to ask you a lot of questions about what you're doing, what your business is, how's it done, et cetera, et cetera. And as long as we can support taking this deduction based on the guidance that we have, we're going to take the deduction. We're not going to be overly aggressive, but if we feel that the law supports it, we're going to take it. The IRS is not going to come back to you and say, hey, you should have taken this 20% deduction. So we're going to take it where we think it's appropriate based on the guidance they've given us.
Yeah, no, that makes a lot of sense. And I mean, it's important to know that this is going to expire in 2025. So this isn't even a permanent thing. So by the time we get case law to back it up, it's going to be expired, and we'll be back to the old rules.
You're stealing my thunder, Charlie.
Sorry. I'm sorry. So, all right, now we're going to talk about the individuals. This stuff is also all temporary. We have a standard deduction went from $12,700 to $24,000. So that was good, but all the personal exemptions were eliminated. So that $3,500 everybody got per family member has gone away. So while we did get an increase there, we kind of took a hit that we lost a lot of that. So a lot of times anybody with a family of 4 actually saw their standard type deduction actually go down.
Yeah, everything, when they were selling the bill, everything they said was, we're doubling your standard deduction. You heard that phrase uttered over and over and over again, which they did. They absolutely did that. But like Charlie said, if you have a family of 4, you just lost more than $12,000 of deductions with your personal exemptions. So at the end of the day, they may not have done quite exactly what they did, what they said they did, but the effect wasn't what they sold it as.
Yeah. Yep. And then the other thing they did was, and this was a big issue for people in New York, New Jersey, California, they limited state taxes, and not just state income taxes, it's state and real estate taxes too, to $10,000. So a lot of people even here in PA, where we only pay 3% on our income, we still pay quite a bit in real estate taxes. And so a lot of people saw their taxes limited to $10,000. And then, so that was a big hit to them on their itemized deductions. They ended up taking that standard deduction. Charitable donations, while they did increase the percentage you could take, the effectiveness of those donations are a lot less because you have to get to $24,000 before you can that first dollar of donations. And then the last thing they did, which really doesn't have an impact right now, but will down the road, the amount of indebtedness you can have, you can take a deduction went from $1 million to $750,000, but it's grandfathered in. So if you have mortgages that were before December 31st, 2017, you can still use the $1 million. It's only the new mortgages that you have to be worried about.
Yeah, and back to that state tax deduction, a lot of people would say, particularly in Pennsylvania, because we have such a low individual income tax rate, a lot of people would say, $10,000, big deal. Maybe between property taxes, state and local taxes, I'm only paying $15,000 a year, so I only lost $5,000 of deductions. The bigger piece of this was it puts flow-through entities at a disadvantage to C corporations. So C corporations can deduct every dollar of current state tax from their federal taxable income every day of the year. Individuals now, since all of the business income is taxed at the individual level, there are a lot of individuals out there losing hundreds of thousands of dollars of deductions every year because the state tax that they pay on their business income coming from an S corporation or partnership is now limited to $10,000. So that goes back in this play between C corps and flow-through entities. C corp rate going from 35 to 21. So then we added the QBI to help out the flow-throughs, but now the flow-throughs are losing state tax deductions. So it just muddies the waters in the comparisons again.
Yep. And I will say though that, not getting too far, at least they also eliminated the P's limitation, which a lot of the higher net worth individuals weren't getting that state tax deduction anyways, and now they're guaranteed $10,000. So another thing that high net worth individuals, now they're getting $10,000 when in reality before they might not be getting anything at all. So, higher net worth people, and we're talking like really high net worth individuals. So the other things that went up, the child tax credit went from $1,000 to $2,000. They also come out the amount that could be refundable from $1,000 to $1,400. They also have a new other dependent tax credit that is for any kid. So now your kid's in college or a grandma or somebody who qualifies as another dependent, you can get $500 for them. So that's always good. And then they decreased the top rate from 39% to 37%. So, I saw a lot of people, made out. And the other thing that it's not on this slide, but the phase out for those child tax credits was like $110,000. Then made it up all the way up to $400,000. So, a lot of people who weren't getting that credit at all or were getting it greatly reduced, even $1,000, they got a lot more bang for their buck, because now they can take the whole thing. And then, like it says there on the last point, all this stuff is going to expire in 2025, which is why on the tax forms, you see all these lines for reserve, because they've redone all the tax forms and they can't get rid of the lines because in 2025, they'll all be back. So efficiency at its finest. So I think it's time for our first polling question, which is probably going to be the most controversial thing that we talk about today, which is Die Hard a holiday movie? And Mark, we talked about this at the Christmas party. I don't want you people to think that accountants, when they get together for holiday parties, are only talking about taxes and stuff and accounting stuff. We had a pretty heated argument about whether Die Hard is a holiday movie.
So I will say there's no right answer to this question, but there is a wrong answer.
Yeah.
So I would challenge anyone to find where the Christmas theme is in this movie.
Oh man, they sing the Christmas in Hollis song. He says, "Ho ho ho! Now I have a machine gun." There is a plastic Santa Claus in there, and they do sing at the very end. The one Christmas song at the very end. So there is some holiday stuff in there.
Just because a movie is released at Christmas time and they reference the time of year that the movie's in, doesn't make it a Christmas movie.
That's true. But it's my favorite Christmas movie of all time. So do we have our polling results yet, Caleb? We do. 51% said false. Man, 51% of the people have no idea what they're talking about. I'm completely shocked. Before we move on, I just want to let you know that just a little diehard trivia. It was actually a book called Nothing Lasts Forever, written in 1977. So there we go. All right, let's move on. All right, now we're going to move on here a little faster because now we're going to talk about the things that have changed. So number 2, planning your business tax future.
So as we said, a couple big things we want to focus on here. You can see the list on there on the slide. Bonus depreciation is the first one. So bonus depreciation is going away in starting in 2022. Let me pull up. I don't have all the years memorized. It's 100% through 2022. After that, every year it drops 20 percentage points until it's gone. So be thinking about that. If you're gonna, you can have you have a big CapEx year in 2022. It's coming in December and it's like, I don't think we can get this project done. You're going to want to do everything you can do to get that placed in service in 2022, because in 2023, you're going to lose, not permanently, just it's going to be deferred, 20% of that deduction. If you can get it all in service in 2022, do it. And I know, 2022, good grief, that's like so far away. Wrong. No, we're only talking a couple years from now. So let's make sure you can do that. And some people will say, okay, well, what does placed in service mean? Does it have to be up and running and producing whatever it is that we produce? No, it does not. It needs to be in the building, it needs to be installed, and it needs to be ready to go. You don't actually have to be using it yet. It just needs to be there and ready to go. So you don't have to have your entire line up and running. It just needs to be there and ready to go. AMT refunds, like we talked about, the AMT credit carry forward, since AMT is gone for C corporations. Those credit carry forwards are starting to be refundable now. It's 50% per year until they're all gone. And then I think in 2022, you get whatever's left over, you get that, the rest of it refunded. NOLs, we already talked about that. We can kind of skip over that. The interest expense limitation. I gave you the definition of adjusted taxable income. So that definition changes in 2022. In 2022, you lose the add back for depreciation. So that is a big deal, because right now, everyone, their interest expense, not everyone, obviously, most companies, because they can add back their depreciation expense, they're not going to have this interest expense limitation. Starting in 2022 and going forward, there is no add back for depreciation. So picture the worst case scenario here, where you're having these killer years in 2021, whatever. So you're expanding your business. You have a big CapEx year in 2022, and you take on a whole bunch of financing, and you leverage your company to put this CapEx in place. Big interest expense, big depreciation. You cannot add that depreciation back anymore. So there's a good chance your interest expense is going to be limited. It's not permanent. You'll get it eventually. But for cash flow purposes, for your taxes and return on investment on a project, you can't necessarily count on deducting all of that interest expense.
Yep. Things to think about as we get closer and closer to that 2022, which seems to be like a watershed year for tax planning. Rate changes, number 3. These are just some real summary slides of all the rates that are changing from 2018 to 2019. Everything's going up a little bit for cost of living adjustments. So I won't read through these slides, but you guys see them. Here, tax rates are all going up. The top rates go from 500,000 to 510, 600, 612, but they all tick up. Same thing for our other new rates. The standard deduction is going to creep up a little bit. At least it should have. That last number's not right. It should be 24,400. The debt for elderly and blind is staying the same. The capital gains rates are going up. All the Medicare, all that other stuff. You can see here on these charts. Pretty straightforward. So that's the rates changes. You can use that as a reference. Now we'll talk about planning for your individual tax future.
Yeah. So before we dive into this, we did get a question what are the specified businesses for QBI? So the QBI deduction, qualified business income deduction, the 20% deduction for flow-through businesses that we were talking about. We said it has to be a trade or business, but it does not apply to a specified service trade or business. Specified service trade or business is one that involves the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, investing and investment management, trading, dealing in certain assets, or any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners. Everybody got that?
Yeah, that was crystal clear.
Yeah. So obviously I'm kidding. It is a very kind of all-encompassing, because there's a whole bunch of, unless you're just a manufacturer, you could probably fit yourself into one of those buckets. They did remove engineering from that definition, so they carved that out. So engineers, you don't have to worry about that. But if you're a lawyer, if you're a doctor, if you're a dentist, if you're an accountant, if you're an actuary, if you're a performer, you're not going to get this deduction if your income is high enough. So if your income's below certain levels, around $215,000, $430,000 a year, if your income's below that, you're probably going to get it as long as you meet all of the other requirements. But what they're going after here is, so let's just say, I'm a doctor and people just pay me to help them with whatever. But I get this bright idea. I'm going to start a flow-through entity, and Charlie and I are doctors, and we're just going to start this partnership, and we're going to pay ourselves something, but then we're going to have all this flow-through income, and we're going to get a 20% deduction from that. Excuse me, the IRS, what they were going after here was that exact scenario where they're saying, well, no, this is just your salary basically, but now you're calling it flow-through income. We're not just going to give you an arbitrary deduction for that. So that's what they're going after here. They did, on the consulting piece, they did say, they did very narrowly define that a little better for us. So you're not going to get hit there too much. But that's kind of definition. We could have a whole course, a whole webinar just on this definition, but wanted to get through that question.
Yeah, and I mean, on the individual, not to, it fits perfectly here with the tax planning for individuals, especially with the QBI deduction. There are things that you can do that will allow us to, get below that, threshold. So if you're a doctor or a lawyer, someone who happens to be a specified service trade or business, and you are limited with the QBI deduction, there's a way you can manipulate your income by putting more money into like a SEP or a 401k, doing certain things that's going to bring you below that $215,000 or $430,000 QBI threshold, and then you'll be able to get the whole thing instead of being limited, because there is a range where you get some of it but not all of it. So that's one planning thing you can do as an individual. So
yeah, it is a definite planning opportunity. So planning for the future for individuals. We put on there everything, and we're not kidding, and we're not. So as Charlie said, all of these individual provisions go away in 2025. Rates go back up. The exemptions come back. The standard deduction goes back down. QBI goes away. So, and we have zero indication now that any of these changes on the individual side from the Tax Cut and Jobs Act are going to be made permanent. The idea was, let's just get this through, get it passed with 51 votes. We'll make it permanent later. Well, later's here, and the climate in Washington hasn't really improved. So I don't see this. I don't see a scenario at any point in time where they can get 60 votes to make all this stuff permanent.
No, I don't either. Though I would be surprised, though, all that being said, that in 2025, being in Congress, when you let this expire and they'll say, well, you're raising taxes.
Yeah.
Instead of saying, well, all we're doing is letting a tax
expire.
That's
a good point, because no one wants to be in office and have tax rates just go right back up.
Yeah.
So yeah, we could see some changes, but as of right now, they're all set to expire in 2025.
Yep. Number 5, IRA contribution rates. This is something, it's the same kind of thing we're just talking about rates, because there isn't a lot of difference because of the, gridlock in Congress. But one thing that did go up that hasn't gone up for like 6 years are IRA rates. So now you can contribute a little more to your IRA, which is about ways to reduce your income. So you can maximize, you can now do $6,000. 401k went up $500, and even the SEP went up $1,000. So now the government is allowing you to put away a little more money for the future. So that's always a good thing here with retirement rates. Number 6, new federal changes.
So actually, one point I forgot to bring up on the last slide, the estate tax exemption. We don't talk a lot about estate taxes, but right now the estate tax exemption is at $10 million, and it's even higher than that actually because it's indexed for inflation every year. Again, this is only through 2025. In 2025, it goes back down to $1 million. So there are a lot of people out there who, it's who have amassed $2 million between a home, between retirement, between whatever. Right now, estate taxes are the last thing on their mind because they know they're never going to have to pay them. Except if this just goes away after 2025, something happens in 2026, you now have a pretty big bill if you haven't looked ahead to make sure you take advantage of the exemption now. There are trust tools you can use to lock in the benefit now. You basically, I'm not an estate trust tax guy, but there are things you can do to protect these assets to use this exemption now. And then even if that exemption goes away, it will be deemed that you already used it, and so it's already sheltered. So make sure you're aware of that. All right. So 2019 federal tax changes. There really weren't any. So everything they said they were going to do that they didn't do, which we already kind of talked about, because of the inability for them to agree on what they want to do. So they said they were going to fix all the problems with the Tax Cut and Jobs Act. They weren't able to do that. It is kind of interesting. In 2018, Congress asked the IRS to enforce the legislative intent of the bill. They said, we wrote the law, but that's not what we really meant. What we meant was this. And the IRS basically kind of laughed at them and said, no, you guys make the law, we enforce it. Because obviously, if the law says one thing and the IRS says, well, that's not what they meant, so we're not actually going to go after people on that. In the case where it's favorable, where the law is favorable to a taxpayer, but the IRS does something different to enforce the intent, that taxpayer is going to win in court every single time. So that was kind of an interesting aspect of all of this. Court decisions, nothing big. They clarified a bunch of stuff for us. There were some procedural changes to make our lives easier, which ultimately makes your life easier. But other than that, not too much going on.
Okay. All right, medical expenses. This is one thing here that that isn't going to affect a lot of younger taxpayers, but may affect a lot of elderly taxpayers that weren't expecting it. It was 10% in 2017 in this part of tax reform in an effort to try, I think, at least it's my guess, is that in order to try to make it easier for everyone to have bigger refunds, they dropped that percentage of your adjusted gross income down to 7.5%. But then in 2019, it goes back up to 10%. It stays up there. So if you have the same amount of medical expenses, if your income's $100,000 in 2017, and let's say you had $10,000 of medical expenses in 2018, you got a $2,500 deduction that might increase your standard deduction to the point where you might be able to itemize, and in 2019, that number is zero because it's gone up another 2.5%. So it could be quite a bit of income. Seniors who maybe were used to getting a little more bang for their buck could see their taxes go up simply because this rate went up. And so I think that's something people just need to pay attention to, is that if you are someone who relies heavily on medical expenses to get above the standard deduction, it's going to be a little harder to do that in 2019 going forward.
That's right.
So there's somebody who, just something to think of when you're looking into 2019. State law changes.
So a couple things we're going to focus on here, and they're kind of, some of them are a blended federal and state issue. In the courts, the Supreme Court decided that a state cannot tax undistributed net income of a trust that is properly sitused and administered in another state. So I'm gonna rephrase that in English. So you set up a trust in a state that doesn't have a personal income tax, say a state like South Dakota, and all of the income is properly legally sitused in that trust in that other state, and you live in Pennsylvania. If you have not distributed any of that income out of that trust to you, Pennsylvania cannot tax it. So that was kind of a big deal in the trust world if you live there. Also, it's been states kind of, you kind of read in the headlines every few weeks now where another state has either decriminalized marijuana, has made it legal, whether medical or recreational, but a lot of states are loosening the rules on that. The feds have reiterated again in the courts and otherwise that marijuana is illegal at the federal level. Why do we care about tax? For tax purposes, you cannot deduct expenses for illegal businesses. You can deduct your cost of goods sold, but you cannot deduct your general and administrative expenses for an illegal business. So you live in Pennsylvania, you start a medical marijuana business, totally legal in Pennsylvania. On your federal tax return, you cannot deduct the general and administrative expenses on your federal tax return. Now, are the feds actually going to come at what? I'm sorry. Are the feds going to come after you in general for doing medical marijuana? Probably not, because it's legal under state law. They can get you on the tax side. They can disallow those expenses. They can get you for tax fraud. They can get you for tax evasion, which is, we all know that's how they got Al Capone. So if they got Al Capone on that, they can get you on that. So something to be aware of.
Funny that the IRS has no problem collecting the revenue, taxing the revenue from the illegal activities. Yeah. They just won't let you grow the cost of goods sold. They also don't let you have bank accounts because all the banks are federal banks, and so if you're in an illegal activity, you can't have that. So that's why
a lot of banks aren't touching it. So we also have Wayfair listed on there. We've talked a lot about Wayfair in the past. The Wayfair court decision that basically said states can tax you even if you never set foot in their state. A lot of people just think this applies to internet sales. It doesn't. It goes way beyond the internet. If you are shipping goods via common carrier into another state, so you sell widgets in Pennsylvania and you put a widget into a box and you put it on a UPS truck and title passes and it goes to that other state. If you do enough business in that other state, you're going to be taxed in that state, or at least they're going to try to tax you. Particularly from a franchise tax and sales and use tax perspective. Every state is coming out with different rules almost every day to say what that threshold is. For example, Pennsylvania has said if you have $500,000 of sales in Pennsylvania, you are presumed to have income tax nexus. Whether or not you've ever set foot in Pennsylvania, done anything in Pennsylvania, you're just shipping sales to Pennsylvania. Pennsylvania is going to say you are presumed to have income tax nexus. Now, do you actually have income tax nexus? No. But can they make you file a return? Yes. You have to file a return. As long as you followed all the rules, you claim exemption under Public Law 86-272. You're not going to have to pay income tax, but you do have to file the return, and Pennsylvania can come after you for that.
Okay, number 9, alimony payments. Divorce just got a little more expensive for some people in 2019. So prior to 2018, if you filed for divorce and it was finalized prior to December 31st, 2018, if the payments that you make that are alimony payments, not child support, alimony payments, were deductible to the person who was paying it, and then the person who was receiving it had to pick it up in income. Now, after December 31st, 2018, alimony payments are no longer deductible to the payer and are now not income for the person who receives it. So if you think about it, if you made $120,000 and you were paying half of it to your, significant other that's no longer your significant other, your income was cut in half and you're probably paying lower taxes because, they're both starting out at zero and going up. Now you have to pay taxes on the whole thing. So divorce has just gotten a little more expensive, just something to think about for 2019 and forward. What does the current administration have in force? So what is Donald Trump talking about now for his next tax proposal?
So as we all know, everything in the headlines about Trump has been tax reform 2.0. Obviously, I'm kidding. Absent all the other stuff that's going on, this would be a big deal because the Trump administration's proposal that they're calling tax reform 2.0 is to do everything that we talked about that they haven't been able to do. Make all the individual tax changes permanent. They want to index capital gains for inflation. What does that even mean? So you buy a stock for a share of stock for $1 today. 20 years from now, you sell that share of stock for $20. You would pay capital gains under current law. You would pay capital gains tax on $19. What they're saying is, well, I mean, a portion of that increase is not due to an increase in the value of the stock. It's just due to inflation. People are just willing to pay more, so you shouldn't pay tax on inflation. That's what that's going after. So basically, it would just lower the gain on the sales of capital assets going forward. They want to lower payroll taxes, not a whole much more specific information on that. They've also thrown out this idea of 2 tax brackets, which I just don't get. I'm not quite sure how, because if you have 2 tax brackets, obviously one would have to be very low and have a really big bracket of income, and then one would have to be very high and basically and obviously by definition have no cap on it. So we would get to the point where if our bottom tax bracket is, I don't know, 15%, then your top tax bracket is 37%. Once you break through that bottom bracket, you now have a 22% incremental tax rate on every dollar of income over that bottom amount, which just doesn't make sense. But that's what they're talking about.
Fine. All right, now we're going to be pulling question number 2. What is your go-to holiday dish? Is it turkey and chicken, ham, fish or seafood, pasta, or beef? So I will tell you that ours is pasta. We have lasagna every year for Christmas at my aunt's house and antipasta. And I eat way too much of it and then fall asleep watching bad basketball games on Christmas Day. So that's what.
You have lasagna on Christmas Day?
I do. And I love it. It's amazing. Lasagna, sausage, meatballs. It's pretty good. So
on Christmas Day?
Christmas Day. That's what we have every year. What do you have?
We don't have a set thing, but lasagna?
That's what we have.
On Christmas Day.
Hey, my mom's side is Italian, and that's what we have.
Interesting. You learn new things every day.
Yep.
It's wrong to do that, but.
Yet again. All right. So, I would imagine most people it's either A or B. I can't imagine. Or if you're Catholic, it's probably C. My brother-in-law's family's Catholic, and they eat fish a lot.
For those of you who eat pasta and have an Italian meal on Christmas Day, I was kidding. It's not wrong.
Yeah,
I just like to tell Charlie he's wrong.
That's okay. I can handle it. But as we can see, obviously, turkey and ham and chicken are the.
I thought ham might be a big one.
Yep. So, all right, let's keep moving on. Keep on moving on here as we're running up here. The individual mandate was repealed. Just to let you know, you no longer have to pay a tax if you don't have health insurance. In fact, that just lost in one of the appeals courts that they struck it down. So it didn't really matter anyways. I felt like it was kind of a waste of time, seeing as the penalty was reduced to 0. But they decided to repeal it. So the individual mandate has been repealed. And then last is the energy credits. And this isn't so much a big deal for the year that we have to file this year, but going forward, the energy credits going down, 30% in 2019, 26% in 2020, 22% in 2021, and then beyond is 10% for business or 0 for individuals.
So if you want those solar panels, you better get them in now.
Yep, exactly. So those are 12 things that are changed that are going to be different for 2019 or 2020, depending, going forward. And now we're going to take a chance to talk about some Democratic candidates. We limited it to the 7 candidates who have made it on stage for, if they even have it, because apparently if they can't get their issue resolved, they're not actually going to have it wherever they're supposed to have it. So
All right. Yeah.
These are the 7 candidates that qualified. So we'll have them up here. You can kind of look at these. Maybe we'll say 1 or 2 things about these that kind of each make us unique, and then we'll move on because we're down to the last 10 minutes.
Yeah, there's a lot of common themes in here, one of which is going to be a higher tax rate.
Yes.
So Joe would want to increase top rate to 39.6, and increase long-term capital gains rates also to 39.6. Basically, make anyone making over $1 million subject their long-term capital gains, just change it to ordinary income. Put a cap on itemized deductions. That goes back to the P's limitation that Charlie was talking about earlier. Increase estate taxes, so you can't just keep passing assets down through generations and getting a stepped-up basis in them. I thought this was interesting. The raise the rate from 21% to 28%. Because Joe, the Biden administration, I guess it's not the Biden administration because he doesn't have an administration. They kind of said, their headline was they're going to completely repeal the Tax Cut and Jobs Act, with the exception of all of these things, which basically means they're not going to repeal any of it. They're just going to change a little bit of it. The S-Corp payroll tax loophole right now, S-Corps, the owners have to pay themselves a salary. The rest of it is not subject to payroll tax, which is an advantage of S-Corps over partnerships. But they're saying they're going to close the loophole. It's not really a loophole; it's just the law. So saying they're going to subject all S corp earnings to payroll taxes, and subsidies. I think we got an autocorrect error in there for fossil fuel. And there we go. There's the headline: repeal the excess of the Tax Cut and Jobs Act.
Yes, and the one thing that's on there that is the step up for death, which can be really costly. Really costly on the tax side for people, because, I mean, if you've got property that's going to increase, that has a lot of value that, is appreciated over the years, when you die, you get to step up your basis to fair market value, and that could be a huge number. So if that goes away, that along with decreasing the estate tax down, that could be a huge hit for a lot of people with estates, with wealthier estates.
Yeah, the estate tax is a tough one because it's very easy and can be popular to say all these, mega billionaires, millionaires, whatever, who die, and then, all they want to do is just pass their assets on to their children. It's very easy and popular to say, well, they should just be paying a lot of tax because why should the kids get all this stuff? But if you have a family-owned business that's worth, a few $100 million, you just want to pass the family business on to your kids. You shouldn't have to sell that, in my opinion, shouldn't have to sell that business just to pay the estate tax. So while it's easy and popular to say one thing, there are very basic, very common examples where I think most reasonable people would say, well, yeah, we can't be forcing people to sell the family business just to pay the estate tax.
Right. Nope, I agree. All right, let's move on. Pete Buttigieg, he had a lot of specifics on his tax policy. Higher tax rates for top earners, doesn't have a specific. Wants a tax on wealth, not work. Likes the idea of a wealth tax, which we'll talk about when we get to some other ones. Says a 35% corporate tax rate, an international formula apportionment, and unspecified financial transaction tax. Didn't have much specifics, but he said he was in favor of some of this stuff. So some people are a little more in the weeds than others, but that's Pete Buttigieg. I don't really have anything to say other than what's on here. Not much you can argue when you don't have specifics.
It's true.
Amy Klobuchar, she wants the Buffett rule, which is a minimum 30%, like a flat tax if you make over $1 million a year. And then they all seem to be into this repealing of lowering long-term capital gains taxes up to that's huge. I mean, Biden had the same thing, but all of them have that, where they want to go up with lower, ordinary treatment of carried interest. That was a big thing 4 years ago. Everybody was on the ordinary income treatment for carried interest. expanded earned income tax credits, raise the corporate rates. I mean, it's like pretty much everybody saying the
Yeah, it's all a
exact same
common
stuff.
theme.
So as opposed to where we were 4 years ago, where it was all about decreasing taxes. Let's feel the burn here, Mark.
Bernie's got a lot of specifics. I'll give him that. And again, all common themes here. The one aspect of Bernie's stuff that jumps out is the premium tax, which doesn't play well politically, but actually makes sense. So basically, just say they're going to add a 4% tax on all income over $29,000, and that's how you're going to pay for health insurance, which isn't the worst idea in the world, and I think sounds a little better than just saying we're going to give everyone free health care. There's no such thing as free health care. Somebody's got to pay for it. So I do appreciate Bernie, kind of coming out and saying we are going to tax you, but you're going to pay less than what you're paying right now for your health insurance, and you're actually going to be able to use it. But yeah, everything else kind of common theme. Increased taxes on the rich.
And then the other one thing there that is unique is the tax on businesses when their CEOs get more than 50-to-1 ratio above their average, that they would have to pay a tax between 0.5 and 5% when their CEO pay gets too high.
Yeah, and he did his research on this one, because one thing we've seen explode over the last 25, 30 years is this CEO to median worker compensation ratio. I don't know the numbers offhand, but 25, 30 years ago, I think the number was like 20-to-1. Might have even been less than that. And now it's, in some cases, it's literally like 300-to-1.
Yeah.
So so there is something to be said for that. Back in a time when maybe the top earners were willing to take a little bit less money and pay their employees more, and that seems to have changed.
Yep. Nope. Completely agree. Tom Steyer, he has even less specifics than Pete. 1% on taxes over $1 million. He's going to close tax loopholes. I love that.
Close all those tax loopholes.
Yep,
all of them.
All of them. Couldn't say what they were, but he's going to close them.
Aren't they just laws?
I guess. Yeah. We wouldn't have a job then. Sure. All right. Our last polling question. What is the current value for the 12 days of Christmas? So there is an actual right answer to this one. I will say that there's actually a true value of Christmas. They say where you get each gift on each day. So you get 12 partridge in a pear trees and then, 11 sets of 2 turtle doves. But this is just when you get one of each, or one of each day. You're not repeating it over and over again. So
this is not the repeating.
Not in the repeating. No. I'll tell you that's $170,000 if you got everything.
I was going to say this seems really low.
It does.
If it was the repeating.
I mean, gold rings. That is the highest.
Right.
Is usually the highest driver because it's gold and it's going up.
And you'd get 40 of them if I'm not mistaken.
I know. That's what the Fonz is always telling me on TV is that I want to invest in gold.
Yeah. Like if you folded a piece of paper over on itself 50 times, you'd be able to reach the moon. Did you know that?
I know. And you can't fold a piece of paper more than 7 times.
Right.
It's really hard. They did on Mythbusters though. So I saw them fold it more, but they had a piece of paper that was as big as like a hanger to get it to fold it 7 times.
That's not.
Well, it was a piece of paper. So that we have our answer here, 58,973. That's actually incorrect. That's the number I made up. 39,095 is the correct answer for this year. The 12,623 is the value in 1985. So if you think about it, that's a lot longer ago than I care to admit. 34 years ago. It doesn't seem like it was that long ago, but the difference is $27,000 from that time. Let's keep moving on here. Elizabeth Warren, I mean, she's going to be a lot like Bernie. I will say this, though, and give Elizabeth Warren some credit. She was the only person on the websites when I was looking up this that had a search function. She has a lot of plans, and I could search tax, and up came all this stuff. So
she has a plan for that.
She has a plan for that, too. I mean, hers are pretty much the same as Bernie. The increase, that's different. The net investment tax is going up, and the wealth tax.
The wealth tax has been the big headline for Elizabeth Warren. I'm not a constitutional law expert, but the wealth tax is not constitutional.
No.
You can't just arbitrarily tax people because they have more money. The Constitution states everybody has to be taxed equally. You can have different rates for different levels of income, but you can't just tax and put a percentage tax on a certain level of assets above a certain number. You just can't do it.
Nope.
Not to mention the fact that I can't imagine us ever having a Congress that would all agree to actually do this.
Nope. All right. Andrew Yang, also not one for specifics. He has one that's a 10% value-added tax, which is unique. And then he wants to give everyone a freedom dividend, which is $1,000 a month for each month of the year. So everybody would get $12,000 just for being over the age of 18. So, I mean, yeah, good luck with this stuff. But that's his tax plan. So that's that. I think that's our last one is Andrew Yang.
And we are done.
We are done.
Right
yes.
at 3:00. We have 18 seconds for questions if anyone has anything.
So do we have any questions? We do. Why isn't there any talk of inheritance tax repeal for Pennsylvania? Inheritance tax in Pennsylvania?
Why? What was the question, Charlie?
It says, why wasn't there any talk of inheritance tax for Pennsylvania? We're one of the few states that has inheritance tax.
All true.
All true, yes.
Unfortunately, we don't make the laws. If we did, all this would be a lot easier.
Yep.
But we can certainly make that a subject of a future webinar.
We can.
We appreciate the suggestion.
Yes. Thank you all very much. Have a happy holiday.
Thank you, everyone.
Thank you once again for joining us for this webinar recap produced by McKonly Asbury. We hope you join us for our future webinars. You can stay connected and learn more about all of our upcoming events by visiting us online at macpas.com. Thanks again and have a great day.